Good evening and welcome back to Be Rich. And my good friend Sashwat Swaminathan also happens to be my nephew is here. And we co-wrote an article in the Hindu some time back. I think it is time to revisit this article. Why am I revisiting this article? This article argued that there's a raft of FMCG companies which are extremely expensive and have mind-boggling valuations in India. And the parents own 75% of the company, and the parents are listed abroad. When we looked at it, we found that buying the parent made greater sense than owning the subsidiary here. The prime companies are basically Hindustan Unilever, Procter and Gamble, and we also looked at Nestle, I think. So these companies, I really wanted to own it in India. It looked frightfully expensive. And lo behold, when I looked at a company, looked at the same parents abroad, it was very cheap. So the reason why these companies are very expensive in India is because normally you don't trust corporate governances of normally Indian companies. So there is always a premium for a company which is supposedly having a clean book. And these book companies have clean books. They have long foresight into you have a long view into the market, and you can look at steady returns. But what has happened in the post-COVID pandemic is sales in rural India has collapsed. In fact, today I saw a Nielsen report, which is very important here, which said that the volumes of sales have dropped, but the values have increased. That means inflation is coming ahead. But that is not what we want to discuss. We want to discuss these companies which are listed abroad, and you get to buy the entire company and you still own the Indian business. So let's look at these companies abroad. So what did you find, Shashwat?
In the research which we had done before we had written the article, a company like Hindustan Unilever, which is supposedly a very fundamentally strong stock, which has zero debt and which most investors would want to hold in their long-term portfolio now. That same company, which had a PE as at the time of writing that article at around 68 back then, it had a PE abroad, that is in the country where it was originally listed, at 23 as compared to 68. And the dividend yield here was around 2%, whereas over there it was around 3.5%.
So you are basically saying you can buy this company at one third the valuation.
Yeah. And another important thing is that we had also discovered that these companies, the parent companies, in fact performed better and showed better growth than their Indian counterparts did. Because I'm guessing this was because they have a way more diversified market, and the subsidiary company didn't perform as well as the parent company for most of these companies. And the company we looked at was Colgate Palmolive. And you had also brought up a point about royalties. So if you want to talk about paying royalties.
Okay. All these companies, the biggest problem I have in owning Hindustan Unilever or Colgate Palmolive, or for that matter, any Indian listed company is there is no secret sauce in manufacturing soaps and detergents. You can go to the nearby market and buy all the material and create a better quality soap. The main thing in soap is marketing that soap. So people get addicted to that brand. So they use this sensory thing, either the smell, touch, feel, hear, or something like that. And they associate themselves with big celebrities. If you remember Hindustan Unilever with Little, the soap, the lady taking bath under the waterfall.
Yeah.
So these kind of iconic things they did. But all that is Indian.
Yeah.
What was happening is they were using the name Unilever. So people said that they have to pay a royalty for using that name
To the parent
to
company.
the parent company.
Yeah.
So there was big payments of royalty from both Unilever, Colgate Palmolive to the parent company.
And
Which was,
what's, sorry for interrupting, but the crucial part here is that the subsidiary company has a majority stakeholder from the parent company. So it's like they're taking from this pocket and putting it into this pocket.
exactly.
But
So they
yeah.
actually own the company. So what are you doing? I'm own 75% of the company, and you are taking royalty and putting in my pocket. You are cutting out the minority shareholder.
And that's us, the retail investor.
That's the retail investor, any investor who is not part of the company. Whereas if you buy Unilever directly, I not only get the India market, I not only get the India dividend, I also get the royalty you pay, which I'll take it and put it in my pocket. So in that way, it made sense to own the
Parent company.
parent. The parent had a better, greater track record He had a better earnings record.
Yeah.
He had a very
Valuation.
reasonable valuation. I had good dividend yield.
Yeah.
I also get the royalty.
And one more important point we had touched upon on our research, which was that the dividend payout for the subsidiary companies are much higher than the parent company.
Yes.
So, and we found this shady because the parent company again is the major stakeholder.
Basically, what is dividend payout is only what percentage of profit is paid out as dividend. That is extremely high in this company. That means what are they doing? They are stripping in the profits by paying royalty, then paying dividend. Very little money is left over for future growth and expansion.
So maybe this could be one of the reasons why we see that the parent company performs better in terms of metrics than.
Definitely it will perform better, no? Because you're anyway, India, for Unilever, India is the largest market.
Yeah.
So basically, I get to use the dividend, I get to keep the royalty. Obviously, I will be more profitable than it is definitely better. And the market there has many options. So it does not see this as a
Value buy.
value buy, but it makes me great sense to buy that stock there.
But that being said, we are limited. We are restricted in terms of how much we can buy abroad. And
No, you are each for a retail investor. There's no limit. Each Indian can legally send $250,000 abroad. Don't tell me which retail investor is going to put more than $250,000 a year.
fair enough. And but what would be, so let's assume that a retail investor isn't very comfortable with the US market or any other foreign market for that matter. What would you suggest for that investor to look at these sort of fundamentally strong companies but at better valuations?
See, then you have to wait for the market to correct. You have to wait forever. There is no possibility of you buying any American stock. Now, they are saying in Gift City you can buy a select few stocks, but you cannot buy anything you want. But even account in Singapore or Dubai, you can buy any stock you want. There is no other way of doing this.
So, how do you think buying, let's say, the S&P 500 index through any mutual fund, passive index fund, would you think that would be a better?
No, the S&P 500 is banned now.
Okay.
There's a limit beyond which companies cannot invest. The S&P 500, the limit is crossed. So that's very difficult.
So the best option now is to just index with the Nifty then?
Yes. For the Indian investor who does not have enough money to
go abroad,
this is the best way to do.
Okay. Thank you so much.
Thank you for watching. Be Rich. If you like this video, kindly subscribe to my channel and turn on the bell notification. If you do not turn on the bell notification, you will be not notified every time a video comes. Also, don't forget to share this video with your friends and relatives and persuade them to subscribe to my channel. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com.